Hey everyone, and welcome back to the channel where we decode the complexities of the market. Today, we're diving deep into a fascinating corner of the stock world, hard to borrow stocks and the potential for a short squeeze. Our spotlight today shines directly on the GrowHub Limited, ticker symbol TGHL, a name that's been flashing on our hard to borrow screener with some truly eye-popping metrics. We're going to break down exactly what makes TGHL interesting right now, what cost to borrow truly means, and what you should watch for. Before we jump in, a quick but crucial reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about TGHL, the GrowHub Limited. This company operates in the technology/software infrastructure sector, providing product traceability, data analytics, and product trading facilitation solutions both in Singapore and internationally. With a market capitalization of $28.06 million, it's a relatively small player, often referred to as a microcap. But don't let its size fool you. TGHL has shown significant volatility recently. Show chart, TGHL 30-day price action. In just the last 30 days, TGHL is up an incredible 132.99%. Looking closer, the last 5 days have seen a surge of 71.73%, and just today, the stock closed up a staggering 53.53%. This recent price action has been accompanied by robust volume, with today's volume hitting 15,689,500 shares, which is 1.5 times its 30-day average volume of 10,175,440 shares. What is cost to borrow and why it matters? So, why are we focusing on TGHL? It all comes back to a concept called cost to borrow, or CTB. When you want to short a stock, you essentially borrow shares from a broker, sell them, and hope to buy them back later at a lower price, returning the borrowed shares and profiting from the difference. But borrowing shares isn't free. Brokers charge a fee known as the cost to borrow. This fee is typically expressed as an annualized percentage. The higher this percentage, the more expensive it is for short sellers to maintain their positions. When this rate spikes, it signals a significant scarcity of available shares and often heightened demand from short sellers. This can place immense pressure on those betting against the stock. Why this stock is hard to borrow right now? This brings us directly to the GrowHub Limited. TGHL appeared on our hard to borrow screener with an absolutely staggering cost to borrow fee of 773.1% annualized. Let that sink in. 773.1% per year. This is an exceptionally high rate, indicating that demand to short TGHL is intense, and the supply of shares available to borrow is incredibly tight. While the exact number of shares currently available to borrow is unknown, the sky-high CTB, combined with an estimated float of 12.7 million shares, strongly suggests that shares are indeed very difficult to locate for shorting. Our internal composite squeeze score, which combines factors like CTB, borrower supply, float size, and momentum, currently sits at 46.5 for TGHL. While this isn't an extreme score, it certainly points to conditions that could become volatile. Squeeze mechanics explained. So, what does it mean when a stock is hard to borrow? It means short sellers are paying an arm and a leg just to keep their bets against the company. This pressure can be a significant catalyst for what's known as a short squeeze. Imagine this: a stock's price starts to rise, perhaps due to positive news or increased buying interest, just like we've seen with TGHL's recent plus 53.53% day. Short sellers, already paying high CTB fees, start to see their positions losing money. As the price goes up, the losses mount. To limit their losses, or due to margin calls, some short sellers are forced to cover their positions. Covering means buying back the shares they initially sold. This buying pressure adds fuel to the rally, forcing more short sellers to cover, creating a cascading effect of short squeeze. It's a self-reinforcing upward spiral, but remember, a high cost to borrow does not guarantee a squeeze. It can also signal that short sellers have very strong conviction that the stock will eventually go down, and they are willing to pay a premium to maintain that bet. Dilution risk check. One critical factor to consider when evaluating a short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This can effectively dilute the value of existing shares and, critically for squeeze thesis, can flood the market with new shares that short sellers can use to cover their positions, thereby negating the upward pressure. A quick check for TGHL is positive on this front. We found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. Furthermore, there has been no recent reverse split for TGHL in our look-back window, which sometimes precedes new share offerings. This absence of recent dilution is a favorable sign for any potential squeeze thesis, as it removes a major headwind for upward price movement. Let's pause once more for that crucial disclaimer. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For TGHL, the Group Limited, the key metrics to watch are its incredibly high cost to borrow fee of 773.1% and the general scarcity of shares to borrow. Combine that with its recent powerful price momentum up over 132% in the last 30 days and substantial trading volume. Continue to monitor the availability of shares to borrow, which can be found on various financial platforms. Any further decrease in borrowable shares, coupled with sustained buying pressure and volume above its 30-day average, could intensify the squeeze dynamics. Conversely, if short sellers somehow find new sources of shares or if the buying pressure subsides, the CTB could drop and the squeeze potential could diminish. The Group Limited, TGHL, presents a textbook example of a stock exhibiting hard-to-borrow characteristics, driven by its 773.1% annualized cost to borrow. While these conditions create an intriguing setup for a potential short squeeze, it's absolutely essential to remember the inherent risks and volatility involved. Always conduct your own thorough due diligence, understand the company, and never invest more than you can afford to lose. If you found this breakdown of TGHL and short squeeze mechanics helpful, please hit that like button, subscribe for more in-depth market analyses, and let us know in the comments what stocks you'd like us to cover next. Your questions and insights help us tailor our content. Thanks for watching, and we'll see you in the next video.